Hi guys, it's Doc's Market Minute for Tuesday, May 5th. I'm looking at the Russell 2000. This is really the most important index chart that's out there right now because it is leading the market to the downside. Now, reversals happen from the inside out. They don't just happen all of a sudden. They start to erode from the bottom, like termites to a foundation. So the changes occur in such a small manner that most people don't notice them until it's already fully underway. And so this is how they propagate. So the daily chart, what we saw was the daily chart making a lower high and then a lower low. And then we knew that that was a change in polarity and game on right there. Now, as this changes polarity to the downside, what's happening is the weekly chart is starting to pull down. Now, that's not a downtrend yet. At some point, the Russell will have to make a high, and whether that turns into a lower high and rolls over again, or whether it keeps on going higher from there and makes a new higher high and stays with the current weekly trend, we don't know at this point. But this is what we're going to look for. At some point here, this is going to stop its move to the downside, and we'll see this by when the daily chart starts to make higher highs and higher lows. So we'll watch for this to change polarity again, back up to the upside. That'll show the beginning of the next weekly swing. And then we'll simply watch for that to either create a new high or set up a lower high and potentially sell off very, very rapidly. A lot of times this move catches a lot of people by surprise. So it helps if you understand how all these puzzle pieces fit together. And that's why we watch price action in the fractals, in the monthly, the weekly, the daily, and then even down to the 78-minute chart when we need to. These are all separated by a factor of 5, and they fit neatly together just like a puzzle. Now, one of the trades that I was watching recently is HSBC. So HSBC, hard to say what trend the monthly chart is in right now, but there's a tremendous amount of energy. So if this wants to release to the downside, it could do so very violently. So what we're seeing is out of this big consolidation zone on the weekly chart, we saw the price actually selling down and then screaming higher to retest from below. But by doing so, it exhausted itself, not only in the weekly chart, but also on the daily chart as well too. So what we are doing is basically playing a fade play on this with a bear put spread. What happens is when the price rallies up like this, the implied volatility drops like this, and we want to play something long Vega at this point. We want to play something that's going to increase in value as the price sells down and the implied volatility goes up. So we're not only putting the price chart and our read of the price chart in our favor as an edge, we're also putting implied volatility as an edge. And sometimes when these edges stack up like this, we can get very quick profits. We're in and out of a trade before it can get a chance to change polarity or do anything like that. So you should do the same as well. Find ways to stack edges up in your trades, and you'll find that that effect multiplies and allows you to get faster profits, more effective profits with these types of trades. So you can only do it with options. And that's it for today's Market Minute. Thanks for listening, folks. See you tomorrow.